Markus, I would like to start with you. You had a Jackson Hole paper in 2012 with Yuliv Sanikov on redistributive monetary policy, and you continued to extend your research further on this topic. So maybe you can tell us a little bit about what are the theoretical channels through which monetary policy may have an impact on inequality, and what does the evidence say? Is there any change in our thinking regarding the impact of COVID-19 on these transmission channels? So the floor is yours, Markus.
Thanks a lot, Phyllis. It's an honor to be on this panel with all the other panel members and with you, and giving me the opportunity to present my thinking. So of course, I think monetary policy has implications on redistributive matters, on income inequality and wealth inequality. And when you cut the interest rate, of course, you help people who have a credit card debt, and you stimulate the economy, boost unemployment, and that's actually beneficial for the poor people. But on the other hand, it also creates higher stock prices. So we have to think about this. I think what's important to understand is that actually there are two channels, and it goes in both directions. So on the one hand, monetary policy is affecting inequality. On the other hand, inequality is also impacting monetary policy. So it goes in both directions. So let me first focus on the fact where there is redistributive monetary policy. And that's, the paper you mentioned, that's what we focused on. To what extent does monetary policy itself affect inequality later on? And is it desirable in what sense? And within this class, there are actually two ways that monetary policy can affect and wants to affect inequality. And one is to stimulate consumption. And for example, you want to shift wealth from rich, low marginal propensity to consume households to poorer, high marginal propensity to consume households. So this way you can manage your aggregate demand better. So that's essentially focusing very much on the consumption aspect. So if you think about the main decisions, one is the consumption aspect. The other main decision for households is the portfolio choice. And if you look at the consumption choice, this shift from rich households with less marginal propensity to consume to poor households with a higher marginal propensity to consume, that's for demand management of consumption. The other choice is a portfolio choice. The portfolio choice is how much risk people take and how much they want to save in a safe asset and money and government bonds and all that. And that depends very much on the risk environment. And it could be that certain sectors or certain households, certain investors balance sheet impaired. And that's, think of the household sector in the great financial crisis, they have a balance sheet impaired, and you want to shift wealth into this household sector in order for them to balance the balance sheets again. But it could also be certain industrial sectors, certain industries, banking sector and so forth, which are balance sheet impaired. And you would like to shift wealth towards this sector in order to bring the price of risk down, reduce risk premia, and stimulate investment. And by stimulating this investment, you essentially create more jobs and you stimulate the labor market as well. And that in turn then lowers inequality down the road. So it goes in both directions in the first place, and then within the direction where monetary policy tries actively to influence inequality in order to stimulate either consumption demand or change the portfolio choice away from the safe assets towards more risky assets, so more investment essentially. The other direction it goes as well, the other direction, if there's a lot of inequality, and inequality could be one driving factor why our star is so low. And if we lower our star, that means we are closer to the zero lower bound or the effective lower bound. That limits monetary policy. So inequality on the other direction is also affecting monetary policy. So it goes in both directions. I think that's the main thing to take away from it. The second thing is I would like to mention, how would you do it and how does it work? And typically, the way redistributive monetary works is through relative asset prices. You make certain asset prices more expensive and others less expensive. So for example, if you have an interest rate cut, of course, you make the long-term bond more valuable relative to short-term bonds or money in a sense. And this change in wealth then actually makes a big difference, because you change asset prices, relative asset price, and it depends who is long, who is short. So who is holding certain assets and who is not holding certain assets. And you can do this now with unconventional monetary policy. You can affect many more prices, not only the short-term interest rate, but you can also affect term spreads, so the difference between short-term and long-term interest rates. You can affect credit spreads, risk premium, and all this. And depending what spread you affect, you will benefit different investor classes, different households, and that gives, of course, the central bank a lot of power. And many people are reminded of the 1970s, where they say, okay, the central bank had so much power, it could grant even credit to certain subgroups. And that's actually, goes beyond the political mandate. And that also undermines, to some extent, potentially the independence of central bank, because central banks, are not supposed to do a lot of redistributive monetary policy, even though any monetary policy does redistributive monetary policy. And that's, I think, the big challenge we are facing more generally. So you also ask, should we care about inequality? I think for sure. I think we have a very narrow view often that we care about price stability and all this. But of course, first of all, we should care about the society's welfare, and that includes social cohesion and other aspects. But we have to be very careful to stay within a clear mandate and be, make sure that it stays within this fairly clear mandate: price stability, economic growth, and financial stability, and how it translates it. And there are many channels where it actually does impact economic growth, as I've just outlined. Now, for the final part of your question about COVID, is it special after what have you learned about COVID? And for me, the biggest lesson from COVID is it's not all about efficiency, it's also about resilience. So that's for me the biggest lesson. And to what extent, we can bounce back. It's not only, minimize all the costs, but to what extent we can bounce back. And for this, monetary policy is very important too, avoiding scarring effects and all this. And that has inequality aspects as well, because it helps the poor if the scarring effects are avoided. So that's my first take on this topic.